In today's class, we'll be focusing on Unit 3. And part of it is about cost accounting systems. We're going to look at different aspects of accounting systems. Last week, we touched on a lot. Touched on what cost objects are. We touched on CVP. We touched on how to classify costs. We touched on nature and origin of costs. We touched on how to estimate, use the linear equation and also the high-low method to split our costs from fixed and also variable. So CVP, we touched on break even and contribution margins and stuff. So with that being said, I know that I gave you guys homework. Maybe just briefly, what was your experience with the homework? If you guys have done it or not, just let me know before we start with today's lesson. Did you guys experience any challenges, or did you have the time to look at the homework that I gave you? Or is it the first time that you guys attend? Remember this class, if it's the first time that you attend, I promote discussing, and I still say that it's not a lecture. I need you guys to participate so that we can see where your thoughts are, and it's a safe place to share your thoughts rather than when you keep it inside. So a simple question is saying, did you guys look at the homework or what we've covered last week? Do you have any questions? You can say it's a simple yes or no so that I can just get and judge where we are. So did you guys have a look at the topics that we covered last week and the homework? Yes, Miss Tolle.
Oh, sorry. This is my first time attending, so I didn't do the homework. I didn't have the homework.
Okay, cool. Thank you. So since it's your first time, that means that you don't have the link to the WhatsApp, or do you? Do you have the link to the WhatsApp?
No, I don't.
Okay, so I'll send it to you. Others, did you guys have time to look at the homework or the topics that we did last week? Or is it your first time attending the class? And please remember, I can't see the hands or chat. Okay, so others are saying it's their first time. For those where it's your first time attending the class, here's a WhatsApp link. Join. That's where we discuss. That's where you will hear if, let's say, there's changes to class and times, where you can even raise any topic and mention where maybe you might be struggling. Okay, so those who haven't been able to look at the homework from last week, it's fine. I'm going to continue for the benefit of those who just came in. If you have any questions, please use WhatsApp to raise questions. I would recommend that every single time when we've covered topics, try to do a revision there and there, because it's easier. You've just got the principles. Now you're applying them, because you don't want to get to a situation where it's late in class. I mean, like, it's late in the semester and you're trying to catch up. So try to make time for management accounting. As I always mention, that management accounting, it's like mathematics. You need to practice for you to get the principles. Okay, so with that being said, I hope you guys can hear me clearly, that I'm audible. If I'm not, please unmute and let me know, because I can't see any hands being raised. Any raised hands and any chats, because I'm on presentation mode. Okay, cool. So I'm moving forward. So today we cover a bit. So with how your units are set up, they try to make sure that you can see the link between topics. Because in the old modules, how it used to be, the topics would be separate and isolated. But in this unit, they try to merge them all together so that you can see the full picture of how these topics link one to another. So with that being said, with today's topic will be, as I've mentioned, it's cost systems. We will be trying to make sure that you understand different functions of these systems, be able to see the difference between three bases of accounting your production cost, and also methods on how to deal with your production costs. Okay, so just to give you an objective of today, we are looking at your cost system and their functions. We're looking at 3 ways that you can account for your production costs and 5 ways that you can deal with your production costs. Okay, so as a way of introduction, cost accounting systems, they help us to allocate costs to the products that you're selling. So if you are selling tables, your cost system helps you to allocate from the information that we'll get is to say, these are the costs that you incur for you to end up having this table. And once you understand how your costs are allocated, you are able to determine your profit, right? Because once you know how much something costs you, you will know how to price it, meaning in terms of selling, and you'll be able to see if you are able to cover all your costs and make a profit. As a result, as a manager, it helps you to make better decisions. And these decisions, they involve planning, controlling your costs, and also measuring the performance of these products. That's a mouthful, but this is just what introduction of saying that the overall picture of having cost systems is for you to know how to allocate, because once you allocate your cost to your product, you are able to determine your profit. And once you do that, you are able to make better decisions that will help you to be able to plan and control your costs. That's the aim. That's what we are trying to achieve. Before I continue with this, maybe just a question just to see if you guys were paying attention last week. What would you say it's a product cost? I repeat, to your mind, what comes to your mind when I say a product cost or production cost? What comes to mind?
An example of production cost, I think there would be the labor cost.
Yes. So people will be working on the product that you are making, a table again, or whether it's a cake. So that's a good one. So labor costs, those are part of your cost. Yes, Lina. So your direct material, like you were saying, labor, direct material, those are your production costs. So with today, what are we learning? We are learning how to allocate those costs to this product that you are making, this table or this tape. We're trying to see systems that we can use in order for us to say it cost you this much to make that table. I hope we are on the same page. So One of them is that you need to be aware that there's certain costs that you incur there and there. So what I mean is that, for example, your direct material and your direct labor, you can quantify them immediately, because for you to start making a table, you will need wood, right? You will need your nails. So those things, you purchase them now. As when? Now. If I'm making a cake, the flour, the eggs, the oil, whatever that you are making for that cake, you will be able to purchase them now. And also your labor. However, sometimes certain costs are not available at that point in time, right? And these are normally your overheads. So for example, cost of electricity, if I'm making a cake, you will only know the units of that you consumed, your electricity after what? After baking. You wouldn't know before baking how long does it take for you to, how much would you consume when you're making this cake, right? Because baking varies. It only comes after. In some instances, certain costs, the overhead costs, they come after you've sold that product, right? So as a result, there's a way of dealing with such. So we will get into that. So I just to say, so yes, there are actual costs that you incur when you're making this cake, right? We mentioned them. And part of those production costs would be your direct material, your labor, your production overhead. But with that being said, just note that sometimes these overheads, they are not available at that point in time. They come later on, right? So let me say another example would be, if I'm making cakes and I'm selling cakes, chances are by the time I've sold my cakes, I wouldn't know how much my rent will be. The rent will only come when? At the end of the month. Do you guys get what I mean? The electricity, if it's not prepaid, the bill of electricity will only come when? At the end of the month. But by that time, I've already sold the cakes. So does it mean that I don't allocate the electricity and rent that goes to that cake? What do you guys think? Would you allocate or would you not allocate your costs at that time? So I'm making cake. The question is, I'm making cakes and I'm only going to get my rent and my electricity bill at the end of the month, right? But by that time, I've already sold my cakes. Does it make sense for me to not allocate my rent and electricity bill to that cake that I sold? Or what would you do in such an instance where your cake is ready and you want to sell it? How would you deal with allocating that cost, the rent and electricity, which will only come later? What do you guys think? I just want to hear. It's not a textbook answer, but if you were in the business of cakes, how would you deal with this situation of allocating your rent and your electricity cost?
You'd have to allocate them before, because once you sell the cake, there's no way of you recovering your rent money.
Good one. But how would you go about it?
I think at this point you'd be working on estimates to say, this is the estimated amount for my rent, this is the estimated amount for my electricity, and work with that.
Correct. So what you're saying is exactly what will be looking at. So the basis of, so thank you for answering. You answered correctly, because like you said, you can't wait. Sorry, you can't wait. You can't sell your cake without allocating that cost, because it will be gone. You have to factor it in so that you can recover the cost, right? So it comes to a point where on 3.2.1, the section talks about basis of measuring your production cost. So there are three ways of doing it. There's the actual costing. This is the one where I'm saying point in time actual cost incurred now. And then there's the normal costing basis, which is the one Noqeba was speaking about. That says that we have to make an estimate. We need to apply our overheads. So that means that there's a predetermined rate that we use for our overheads, because at that point in time, the rent and the electricity costs are not yet known, but we need to recover them. So as a result, we come up with a predetermined rate. So over and above the actual cost that you've incurred for your material and your labor. I hope you guys are all together with me. So that's called normal costing basis. Then the third one, it's standard costing basis. Standard costing, that means that there's certain targets that we set to say that my material that I buy, it needs to be 15 Rand per 2.5 flour. I'm sticking with the cake example. The eggs, they need to be 80 Rand for 30 eggs a tray. I'm just making an example. So there's certain targets that you've set as to, this is how much I will pay for my direct material. This is how much I'm going to pay for my labor. This is how much that I'm going to pay for my rent and my electricity. And for this amount of cakes that I want to produce. So standard costing, you're already putting in a target. But actual and normal costing, they are based on actual cost, right? But standard costing, it's target. So they're just indicating to you as to how to deal with your costs. That's all we are figuring out here. How do I deal with my costs? So there's three ways of doing it. As I've mentioned, actual is the actual ones that are incurred now. Normal cost, it's a bit of actual plus predetermined rate for my overhead. And then the last one is standard costing. We're not going to touch on standard costing today. We will briefly touch on it, but I want us to focus on actual costing and normal costing. So, as I've mentioned, actual costs are historical, incurred at that time. And normally, it's your direct material and direct labor. You can directly trace them to the number of cakes that you've produced. An example that they give us here on 3.1 is that this company, they manufacture tents. And for the month of June, they've produced 400 tents. And the costs that they've actually incurred are as follows. They give you direct material, direct labor, production overheads. So the total cost of producing these tents, it's how much you have to add 100 and 120 and 180. It gives you 400,000 Rand. How many units were produced? 400. So cost per unit would be 1,000. You go 100 divided by 400, 250. So you get the unit per cost, and then you get the total. So you get the total cost and the unit cost. So these are actual costs incurred. But this is not reality, as I've mentioned, because most companies experience fluctuations. Things vary every single month, right? So it's not that practical. It's not normal in practice in any person's business that they use actual costing basis because things happen. So most companies, what they use, it's normal costing basis. And how does normal basis work? As we've explained, you need the best estimate of your actual cost of direct material and labor use. And for your overheads, you use your predetermined rate. All right. Predetermined rate, you use your predetermined budgeted rate. It's what Notoba was saying. It's an estimation of saying, normally, budget, we know that your rent is 5,000 for that factory that you are using or that bakery that you are using. So you use the rate of saying that that's my budgeted amount being the 5,000, but then how much will it cost me per unit? So we'll look at an example now, because that 5,000, you can't just take that 5,000 and put it on one cake. You have to take that 5,000 and say, all right, so this 5,000, what is my driver of this 5,000? It has to be the actual production. So you'll always look at whether that actual output, is it based on labor? Is it based on machine hours? Is it based on units of production? In the test, they tell you what would be your output basis. I hope you guys can follow. Please feel free to ask any questions as I go, okay? So I'm going to take it slow with the examples before we do a question. So, Great Outdoor still producing tents. And they're telling you that they are using normal costing as a basis, right? And they tell you that your overheads are assigned to production at a predetermined rate. That's the estimated rate of 430 per tent. Meaning, for one tent, you the overhead cost would be 430 per tent that you produce. There were no opening inventory, great. So they tell you that during June, 400 tents were manufactured. And these are the costs that they actually incurred. Okay, so how would you calculate this? So the cost that they gave you, this is direct material, direct labor, production overheads, it's fine. How would you assign this cost under normal costing basis? You will take your actual cost that you've incurred for your direct material for these tents, it's 100 Rand. You will take your actual cost that you've incurred for your direct labor, that's your 120. But when it comes to production overheads, that's where we play the predetermined rate. So you have to assign it. How do you assign it? You know that you've produced 400 units, meaning 400 tents. And they did tell you that your rate, your estimated rate is 430 per tent. So you'll take that, multiply by this, because by the time you assign this amount was not there, this 180. So you have to come with the best estimate. So as you can see, that it's 172, and then the total input cost will be 392, and your cost per unit is 980. What we can notice from here is that our production overheads that was assigned is not the same as the actual production overhead that we incurred. So 172,000 it's smaller than 180. So what happens is this. In such instances where there's a difference between what you assigned, let's say what you estimated versus what actually happened, we call it the under or over absorbed. How much cost was absorbed? So in this situation, we under absorbed. We took fewer costs. Did you guys get what I mean? We took fewer costs. But as we go ahead, you will see that you will need to put the difference between this 172 and this 180 into your income statement. Because at the end of the day, when we balance our books, you need to make sure, because at the end of the day, you will be paying 180, but you made an estimate of 172. So that means that you under absorbed, under allocated, underestimated. So you need to put in the difference as an expense, because it needs to tie back to what you actually paid in your bank account. If it was the other way around, whereby you overestimated, you will have a cost saving. Do you guys understand? Are there any questions based on what I just mentioned? Do you guys understand the difference between when you assign a cost and when you have the actual cost? That any difference between what you assigned and what you actually incurred needs to go into the income statement, because at the end we need to balance our books, right? But it depends. If it's an underestimation, that means that you allocated fewer costs. So as a result, you need to put in an additional expense in your income statement. But when you overestimate, you've made a cost saving, because that means that you overestimated, you overallocated your costs to your production. Are there any questions from what I just mentioned? Because it's very critical before we move to direct and absorption. I mean, like the actual income statements and stuff. Are there any questions from what I've said? Do you guys understand what I've mentioned? A simple yes or no. Hello?
I understand.
Okay. Thank you.
Yes.
Okay, cool. Okay, thank you, thank you, thank you. All right, cool. Then, so that's over and under that we've mentioned. So we looked at actual costing, we looked at normal costing. Now the third one that I've mentioned is standard costing. And with standard costing, I said we'll touch it briefly. Standard costing, it's more on, like I said, you use your targets, right? So you'll have a target to say, this amount of quantity will cost me this much. So you have a target, because normally people use standard costing to control costs and also for performance measurement, to say, why were we unfavorable against what we targeted? Why were we favorable? If so I'll make an example. You have a certain target of, let's say, these type of labors, you will pay them 10 Rand per hour. But in actual, you end up paying them 12 Rand per hour. So you are on an unfavorable position, because you told yourself that you pay, but you ended up paying with 2 Rand extra. So standard costing helps you to have an understanding as to why did you end up paying 2 Rand extra. That's when now you ask management as to saying, what cost, what happened. Was there overtime? You ask them, did you end up using highly skilled people? Because highly skilled people, they come with more costs. Or were there any strikes? Like, what's going on? How come we spend R2 extra? Same thing if you made a favorable position of saying that, okay, I'm expecting my neighbors to work 10 hours to produce 100 cakes. How come they ended up using 8 hours? That's when now you inquire, efficiency, how come they worked so well and they saved me 2 hours? What happened? So they'll tell you, hey, you know what, learning curve, people now know what they need to do. People are no longer taking too many smoke break or long lunch. People are actually working. So as you can see, it's a good insight into your performance measurement as to measuring your targets versus what actually happened. Okay. We will get into more detail as to standard costing versus budget, flex budget later on. But this is a good read of saying, an introduction of saying what is standard costing and how does it work. Okay. As you can see, it's quite long. Yes, so let me get here because I'm trying to get to absorption and variable costing. Cool. So we've looked at 3 ways of measuring and allocating production cost. Now we're looking at methods that we use for valuing a finished good. And these methods include absorption and variable cost. Right? So those are the 2 ways of measuring finished goods. Absorption costing, it's known as the full costing method, meaning it treats all your production costs. Remember, I said production cost is your material, your labor, and your overheads. It takes all those costs as your product cost, meaning for this cake, I spend this much on my flour and my eggs and my milk and so on and so on. My direct labor, my people who are my bakers, this is how much they actually cost me. This is the electricity bill. This is the rent that I paid. So all those costs, they go on the product, which is the cake. That's absorption costing. Variable costing on the other side, it says I only want to know only my variable cost, meaning for this cake, my product cost would be all variable costs. So direct material, direct labor. What were my variable production costs? Those costs that are variable, they are attached to this cake. So you'll ask yourself, so what about the fixed production? Those fixed production overheads, your rent, all those fixed ones, they are treated as an expense and not as a product cost. So what does it mean? It means that under absorption costing, your cost of sales, under absorption costing, your cost of sales, remember there's revenue and there's cost of sales. Your cost of sales will have a full cost, both your variable and your fixed. However, under variable costing, your cost of sale will only have your variable costs. Okay, are we all together there? That's absorption versus costing method. Do not confuse the two. Okay. So let's look at an example.
Sorry to disturb. Can we go back to that one to say you're saying that variable on absorption, variable costs are product costs, and then on the other one, the fixed costs are. I'm confused.
Okay. So there's two methods of valuing your finished goods. Finished goods, it's your cake. It's a finished product. There's
Yes.
two ways to value that cake. So when we say value, we mean cost of sales. What goes to your finish? So first method, the absorption cost. The absorption costing method says that for this cake that we made, the cost of sales, the cost for this cake would be my variable cost, meaning your direct labor, your direct material, and your fixed and variable overheads. So all these costs, they call it the full costing method. All these costs will be the value of that cake. All those costs are going to be on the cake. That's number one. We understand, eh? That's number one. Then another way of valuing this cake, it's called the variable costing method. The variable costing method says that all direct cost, all variable cost will be our product cost. Meaning, for this cake, I'm only looking at direct material, direct labor, all variable costs that went into producing this cake will be the value of this cake. Meaning, we're not taking fixed cost into this cake under variable costing, but we are under absorption costing. Do you see the difference?
Yes, I do. Thank you.
Yes, so under variable costing, the fixed cost that you are not taking into account in that cost of sales, in the cost of that cake, we take it as an expense. Hence, they call it a period cost. It's an expense. It's not a production cost.
Cool, makes sense. Thank you.
Cool. Any other questions? Feel free to ask questions. Yeah? I'm just checking. Cool. So I'm continuing. So let's look at an example, 3.6. So this is what we get from the account record of this company for December. So they give us sales, they give us sales and distribution expenses, they give us admin expenses, direct material, direct labor, fixed production, and variable production overheads. So how would it look like under absorption and variable? So absorption is this one, and then variable is this other one. So let me change the colors so that you can see the difference. Cool. So the sales will be the same under these two methods, because remember these two methods are all about valuing the cake, value the product. The sales will be the same. We sell it the same. It's fine, 8 million, 8 million. But what we're interested in, it's this portion, cost of goods manufactured and sold. So in both instances, direct material is taken into account. You guys can see, right? Direct material taken into account. So let me put it here. Direct material is the same on both sides. Direct labor, both sides, it's the same, because we both want those costs. Only difference is that there's fixed production. This is where now it separates the two. Under absorption costing, that's where we take into account fixed overheads. But under variable costing, we don't take that fixed production into account. Okay. Variable production, both sides, we want those sides. So you can see from here that actually absorption costing, the only difference is that we take into account fixed, while under variable, we don't. So you can see that the cost of this cake is different. Under absorption cost is 4.8, but under variable, it's 1.6. Do you guys see? And another difference is that under absorption costing, we call what you just calculated gross profit. So this is called gross profit. But under variable costing, we call what you just calculated here to be contribution. Remember last week when we were doing CVP, we looked at contribution. Contribution is your sales less your variable cost. Do you guys remember? I hope you do. But variable costing, think contribution, sales minus variable cost. Absorption costing, it's gross profit. It's sales minus all cost, full cost, both variable and fixed. Okay, so the net profit, here it goes, we continue. So now we've calculated our gross profit, our contribution, here it is, just from top, you bring it here. Period cost are your expenses. You're saying these are not part of my production. These are my non-manufacturing costs. Remember last week we spoke about manufacturing costs and manufacturing. So period costs are the expenses that you incur, but they are post-production. It's after you've produced the cake. So some of the costs that you incur is the sales and distribution expense. So they are on both sides. Your admin expenses, they are both on both sides. You incur them both. Only difference now is that under variable costing method, it now requires you to recognize that fixed overhead. So it comes here under period cost. Any questions from what I just indicated now? So I need my chart. Any questions, guys? Do you guys see the difference between the two methods? Simple, yeah. Please, just to show that you guys are listening.
Yes.
Hey. So what's interesting is that the net profit under both methods stay the same. Why do you think the net profit would stay the same though? Or rather, can you guys guess what could cause the net profit to be different? Because it can be different. What do you guys think could cause, from how you know the income statement to be looking like, what do you think could cause the net profit to look different? Because at this very moment, when there was no opening inventory, the net profit was the same. So what do you think could change that? You guys can just give me what comes to your mind. What do you think could change that net profit to be different?
Maybe if the opening inventory is included. if there is an opening inventory or closing inventory. I think.
Yes, you are right. So the net profit here makes the net profit at the moment is the same because there was no opening or closing inventory, right? It balances what you didn't include here, you included here, right? However, if there is a closing inventory, you will see the net profit would be different. So let's look at it. 3.7. Thanks for answering. So assuming that 100,000 units were manufactured and only 99,000 were sold for 8 million, that means that 1,000 will be our closing inventory, right? You guys follow. You produced 100,000 units and you sold 99,000. That means that you will remain with 1,000 units at the end. And then the unit cost, they give it to you here. Direct material, direct labor, variable overheads, total variable costs. And then they give you the fixed overheads per unit cost, the total manufacturing cost per unit. It's different. You guys see, under variable is 16.8. This side it's 48 Rand because there's no fixed overheads. So now from this information, let's determine the following. Our sales will be the same, 8 million all around. Cost of sales, as you can see, it's different. It's 99 multiplied by the 48, so you get your 4.7. And this side is 16.8, you get it, there it is. And then your gross profit versus contribution, you can see this side is more, 6.3. This side is less, it's 3.2. Your product, your period cost, you have your sales, you've got your admin. They're the same both sides. And then this side, your fixed overheads, you bring it to period cost. As a result, your net profit now different. Under absorption cost, you guys can see, right? It's 846. While as under variable, it's 816. So it's lesser compared to this side. Right. And the value of your closing inventory, as you guys can see, it's 48 Rand this side because we had 1,000 there. And then 1,000 there. This is 16.8. So, as you guys can see, yeah, under your value of closing inventory, if I may ask, remember when you're doing your cost of sales, you say opening inventory plus what you purchased minus your closing inventory. Where does this minus your closing inventory, where does that amount go to? Because we're minusing this 48,000, right? Where does this 48 go in terms of your financial statements? Because we're taking it out from the income statement. Where does it go, if I may ask you guys? Where else would you recognize that 48,000 Rand? In terms of accounting. Yes, Lina?
It's gonna go to statement of financial profit under assets.
Yes, it will go to your balance sheet, right? Your financial position. It will go to your balance sheet as your inventory. So do you guys see that under absorption costing, we're taking a huge chunk of our cost to the balance sheet and reducing the cost under our income statement. And as a result, you have higher profit. Do you guys see? As opposed to under variable costing, all your costs are going to be incurred. We are all going to see all our costs. Hence, the profit would be less. But under absorption costing, because we're saying the production cost includes fixed overheads, a chunk of that goes to balance sheet. It will be recognized next year. So we're delaying the cost of our closing inventory. And as a result, absorption cost, whenever there's a closing inventory, it will have a higher profit compared to variable cost. Do you guys understand it? Do you guys want me to explain it again?
Please explain it again.
So what I'm saying is that is it Lena? Lena, I asked her, where does closing inventory go? She said to the balance sheet. And when you do your income statement, you will say cost of sales, it's opening inventory plus my purchases less my closing inventory. And this less my closing inventory, that means that I'm reducing my cost, right? I'm reducing what I've paid in the opening inventory by this closing inventory because I'm taking it to the balance sheet to say we will sell it next year. We couldn't sell it this year. So we're taking it to the balance sheet. And as a result, because you are reducing your cost, your profit will be higher. So absorption cost, you are delaying majority of your cost to your balance sheet. And as a result, you are making more profit. Whereas under variable costing, all your costs are going to the income statement. If you are taking something to the balance sheet, it will only be your variable cost. It won't be your fixed cost. Because under variable costing, we only take into account variable costs. Absorption cost includes fixed, right, in your closing inventory. Therefore, there's a fixed cost that's making us, I hope I'm making sense. Therefore, the closing inventory under absorption cost is higher than the one under variable cost. So as a result, the net profit under variable costing will always be lower than the one under absorption cost. Do you guys understand what I just explained? Or where does it confuse you? Maybe let me ask that.
So you mean the closing inventory under absorption cost is higher because it includes the fixed cost?
Correct.
Oh, okay, I get it.
And because it includes fixed costs, and because you are taking that closing inventory to balance sheet, that means that you are reducing your cost. And if you are reducing your cost, that means that you will be making more profit.
Okay.
As opposed to variable cost. Variable cost, you are only taking variable cost to the balance sheet, not the fixed cost. The fixed cost you incur it fully. So as a result, the profit will be lower. So that's the difference between, once you have a closing inventory, when you are using this method, your profits won't be the same. Absorption cost will always be higher than variable cost. Why? Because of fixed cost. Your fixed cost will be taken to the balance sheet under absorption costing. Okay, we'll look at another example.
Which method is more realistic, like in a practical business environment?
It depends, right? It depends. Some companies in practice, they want both. Because one would say, I want to see a direct costing method. Most of the time, management accountants, they want to see this one because they want to see their contribution if they are able to cover their fixed costs. But IFRS ways of accounting, most people for reporting, they use absorption costing. So I'm saying that in companies, most of the time they use both. Variable cost, they use it for decision making. This one, they use it to comply with IFRS. Because IFRS says that, here it is, under IS2, it says that the cost of conversion includes a system allocation of fixed and variable production costs. Here it is. So absorption costing is your way of complying with IS2 for reporting. But management accountants, normally they use variable costing method. Why? They want to see contribution to say that, will we be able to cover what? Our fixed costs. Remember, break even. Will we be able to make profit or not?
Okay.
I hope I'm answering your question. So they are both used for different purposes.
Thank you.
Yes, but it does. What you're trying to say is that the whole thing that I was explaining about the net profit being, don't take this to say, why is my profit not the same? Your profit won't be the same because under absorption cost in the IFRS way, it says that my closing inventory must include fixed cost. So if I'm including fixed cost, that means that a portion of my cost is reduced. Therefore, I'm going to make more profit. This side, fixed cost is seen as an expense, so I'm going to incur it fully. This 3.1 will be incurred fully. So as a result, my net profit will be lower. That's the only difference between the two. Okay, so I want us to do a question. When I say I mean you. So it's an exam question, UNISA question, it's an old paper. And I want you to time yourself. So it's 18 minutes. 18 minutes, and it's a 15 marker question. So let's look at it. We'll go through it together, but I'm going to time you guys. And please attempt it, even though you might not understand, but try and attempt so that we can see if an issue is you understanding the theory or is just exam technique. So it's a 15 marker question, and it reads as follows. So the management accountant has presented the following information for Vivo Pty Limited, which manufactures a single product type. What cost do you have here? They give you, so can I just reduce it a bit? Sharp. Prime cost. Remember I told you last week that such definitions, they come back, but here they are. So there's prime cost. Change my color here. Yeah, cool. Prime cost, meaning your variable cost, it's 120, and then last year, 2012, it was 105. Selling price per unit, the selling price per unit this year being 2013 is 200, and last year it was 180. Okay. Overheads, manufacturing variable, it's 45 Rand per unit. Manufacturing fixed, it's 150,000. Your selling and admin fixed, it's 80,000. And your selling and admin variable is 2 Rand per unit. What additional cost do they give you? Additional information, they manufacture 20,000 units each year, both years, no? Units sold during 2013, it's 15,000 units. So they manufactured 20, but they only managed to sell 15. The cost structure, except for prime, remained unchanged. Okay. The open, meaning fixed cost, is the same this year and last year. It didn't change. Opening inventory value for 2.5 units, calculated for IFRS purposes at the beginning of 2013, was 393. Do you guys see they said IFRS, no? Just saying. And there was no opening value, opening inventory for the year 2012, sorry. And they used the weighted average method. So now, what are you required to do? You are required to use the contribution statement of comprehensive income. That's your direct cost, what you just, direct costing method. So they want you to do that statement. And then they want you to do another statement for 2013 using absorption costs, absorption costing method. So 18 minutes. Let me do this. Can you guys still see if I put it on this? Is it fine? Can you guys see? Yes, no?
Yes, you can.
So I'm going to give you, it's 18 minutes. It's 15 times. I want you to practice. So 15 times 1.5. Yeah, 1.2. So 15 times 1.2, it's 18 minutes. So I'll give you 18 minutes to do this question. Attempt it, and then let's talk. I will mute myself, and then let's talk after 18 minutes. Is that fine? So 18 minutes, I'm putting my timer on, and it starts now. Please, please attempt the question. Just attempt the question, and then see if you understand the principles that we just discussed. Okay, cool. 18 minutes starts now.
Okay, I didn't finish. I did question number 1A, question A. And then my challenge was we are giving the prime cost to the per unit, and then we've got the selling price. So I end up like having my contribution was lesser than my sales. My variable costs were more than my sales. So I just want to understand when we're doing the solution that was wrong. That's what took time. I couldn't move on because I was surprised.
Time, né? Okay. All right. Thanks for those who attempted. Is there anyone who'd like to make a comment? So time is an issue, and besides time, not knowing where to put the cost, so it means that still more revision on the topic that we just covered, yeah? So that you get to a point of knowing how to structure your answer, meaning how your income statement even looks. Before you even start putting in the numbers, you just start by writing the full structure of a variable income statement. How does it look like? So you'll have your sales, your cost of sales, contribution, you write it down, your period cost, you write them down and you say net profit. And that's when you start slotting in the numbers. B, same thing. How does an absorption costing income statement look like? Put in your sales, cost of sales. Now there's gross profit. Then you have the cost. I'm just saying that helps you with managing your time. Then things as not knowing where to put selling admin. Is it fixed? Is it variable? Where do I put? How do I? All those indicate that you need to revisit the topic and learn what do you put under variable cost? What do you put under absorption cost? So that's an indication of you need to go revisit the theory. So to become sure, then you practice. So let's go. And they told you that it's weighted average method to evaluate your cost. So let's see. So in income statement under direct costing, you'll have your sales. So sales is straightforward. They told you they sold 15,000, right, in the current year. And they told you that the selling price per unit is 200. So you say 200 multiplied by 15, 3 million, clean, done. Then we know here it's your cost of sales. So that's your variable costs. Do you have an opening inventory? Yes, we do. They told us. Where's the open? They told us here that your opening value is 2.5. However, the cost that they have here includes fixed costs, right? So you have to now go find what is the cost per unit from the previous year. That is variable cost, not including fixed cost, because the 393 here includes fixed cost because they told you for IFRS purposes, for financial accounting. And I told you that financial accounting means that you will now include for fixed cost. So how did they get the 150? They took 105. Here it is. Prime costs are variable costs. They told you last year it was 105. So that's the 105. There it is, 105. You also try find another cost. They told you that the cost, they remain the same except for prime. Here it is. The cost structure except for prime remained unchanged from 2012. So meaning manufacturing overheads remained at 45 Rand per unit. So that 105 plus 1 plus 45 gives you 150. Are there any questions on your opening inventory? Are there any questions, guys? Yes or no?
Yes, ma'am. Can you please explain opening inventory again?
Opening inventory, they gave you the units, is 2.5. Do you guys see it? Here it is. Opening inventory is 2.5 units. Nah. But the value that they gave you here, they said it's for IFRS purposes, meaning it includes fixed costs. Because remember, absorption costing represents IFRS. It represents accounting. You need to take into account fixed costs. But variable cost, we said variable cost, direct cost method, no fixed cost. I explained that thing. So that means that you can't use 393. You have to go and find variable cost because you are doing a direct costing method. So you need to go find variable costs that the previous period. So what are those costs? It's prime cost. They told you that it's variable. So it's the 105. They gave it to you. The second one, it's this one, manufacturing variable cost of 45. So 105 plus 45 gives you 150 per unit. Then you multiply it by the 2.5, it gives you this amount. Any questions? Yes.
If I just did it in a different way, it gave me the same answer. However, I'm not sure if it's the correct way.
How did you do it?
I said 3 million divided by unit manufactured of how many that units? 20,000.
Yeah.
And then it gave me 150, and then I times that 150 by 2.5, the opening inventory, the closing inventory, and then it gave me 375,000.
I hear you. So you apportioned. I hear you. I'd say this one, it seems less complicated than yours.
Less
I don't know. For me, because the numbers are there, I don't have to apportion. I don't have to divide. Because your way, I now have to think, okay, 3 million. Okay, fine. That's sales. Then you divide it by how much. So for me, that's apportionment. But I'd say this one is straightforward because I'm basically saying I can't use this 395 because it includes fixed costs. So what were my variable costs last year? I've got 45, I've got 105, and I've got the units. So I'm straight, I'm done. But to each their own. I'm just saying whatever that is easy and that you can explain and understand, as long as it falls under the whole concept of saying, under direct costing method, my opening inventory needs to be variable costs. That's the only logic. But yeah, to each their own. If you're used to apportionment, do apportionment. But I say the quickest way, it's easier so that I can go to the next thing. Okay?
All right.
Fine.
Thank you.
375, 150. And the guy who asked for explanation, do you understand how we got the opening inventory? Are you comfortable now? Okay, I lost them. Guys, you need to participate. As I said, it's an ongoing thing. You tell me your thoughts, I tell you how you go. That's how you understand, as opposed to keeping your thoughts with yourself, because as a result, you end up not validating anything or confirming anything. So the way we learn is for you to attempt. If you don't understand, I don't mind explaining until you get to a point where you understand. And when you say you don't understand, you need to tell me exactly which point you don't understand. Okay. Fine. Next one. So after finding your opening inventory, you now need to know your variable costs for manufacturing. What are your production costs? So as mentioned, we produced 20,000 units. So there you go, 20,000 units. But now you need to get what are my variable costs. So you look at number 2. Your variable cost is made up of prime cost, 120, plus the 45. That manufacturing overheads, that's variable. So there you go. It's 165. As a result, you've got 3.3 million. Did anyone have a challenge with this? Who needs an explanation? Can I move on? Okay, take the silence as a yes. That one is straightforward. Then as a result, thank you. So your opening inventory plus your variable manufacturing cost, they give you the cost of goods available for sale. Just 3.675. You add this. You still need to less now. The part. There's your closing inventory. So what is your closing inventory? Your closing inventory, how you calculate, you say, what were my opening inventory units, which is the 2.5? How much did we produce this year? 20,000. And how much did we sell? So you take it out, which is the 15. Then your closing inventory is 7.5. Did you guys get the 7.5? Did anyone get to the closing inventory? If not 7.5, how did you get to your closing inventory?
Yeah, I got 7.5.
Good, Ayanda. That's good. So after getting that 7.5, this is where you apportion. I think it was Kumulemo, but I'm not too sure. Where she apportioned for opening inventory. We use apportionment for closing inventory. So you'll take, this is my closing inventory over my total production, meaning what I produced plus the opening inventory, that's your 22, multiplied by the cost that I just calculated here, meaning my opening inventory plus the variable cost, then that's how you will get your closing inventory. What's the cost? So it's 1.225. Did you guys apportion the cost, or how did you find your closing inventory? How did you guys approach the closing inventory value?
I did it like the way you are doing it, but my amount for 3,675,000 was wrong.
What did you get for that? What was your 3.6? What did you add?
Because under opening, my cost price was wrong, and also under variable, my cost price was
What
wrong.
did you add under your variable manufacturing?
Under the variable, I said under opening, right? Under variable, I said multiply by 120 instead of 165. I only used 120. And also under opening, I also used 45 rand instead of 150. So I didn't add the two.
Okay. But now you see why you had to add them both.
Yes, now I see.
Yeah, cool. Thank you. So, closing inventory, you normally apportion. Yeah? You take your closing inventory, you divide it by the total production or goods available for sale, depends how you look at it. You multiply it by this cost that you would have calculated, then you deduct. Then that will give you the variable cost of sales. Cost of available for sale minus your closing inventory gives you your cost of sales. Then remember, contribution, how we defined it from CVP, it's sales less all variable costs. So after you have discovered what your cost of sales is, you then need to put in your variable sales and admin costs, because they are still variable costs. Yes, they are not manufacturing, they are non-manufacturing, but for me to determine my contribution, I need to take into account all types of variable costs, both manufacturing and non-manufacturing. So after you got your cost of sales perfect, you then take into account your sales and admin cost, which was this 2 rand per unit. Did you guys take it into account before you said what your contribution was? Did you take it into account here, or did you take it under? Where did you put your sales and admin? Or did you not even put it in?
I did.
And where?
I did put it under the variable selling, under
Well,
the variable manufacturing. But my answer is wrong again, because I said 15,000 multiplied by 200 rands.
why 200? But 200 is the selling price and the cost 2 rand.
Yeah, that was my mistake.
And remember, this one, you don't put it under your cost. You don't put it with your cost of sales, but you put it after. Nah, please don't make the mistake, because I said cost of sales, it's your manufacturing cost. What did it cost you to produce whatever you're producing? Your sales and admin, it comes after production. So that's why you have to show that this is your cost of sales. Then there's this 30. So you see, you even get a principal mark for knowing the position where you put your sales and admin. Then you get a principal mark for acknowledging that there's a contribution being calculated. You see, they're saying wording to say contribution, you get a mark for it. That's why I always say, put your structure in place. Then you will worry about your calculations later, because there are certain principal marks you get. Okay. Then, after getting your contribution, you less your fixed costs. And what are your fixed costs? You are given your fixed cost. They gave you the 80,000, it's the 150. It's straightforward. Hence, they even said given. So if you knew how to do your structure, this one, you would have, I always say, start with what you're given. Start with what won't give you a headache. You write your structure to say, I'll have sales, I'll have variable cost, I'll have variable and admin, I'll have contribution, my fixed cost. Which one is easy that I don't even have to think of? I just put in my fixed cost because they are straight. Then I go to my sales because it's straight. My variable and sales is straightforward. What I'll struggle with is here. But at least you got your marks. So when you do questions, you'll see as we progress, you guys will get there. Where you now, after you know what's what in terms of knowledge of what's fixed, what's variable, what do I do, where do I put this? After you know all of those, you now need to learn exam technique. Exam technique meaning you reduce the time that you spent on doing the question. You now start with the easy marks. You now start knowing where to put what, where, how, than just being stuck on 150 and 165. Because there's other marks available. So these ones are easy marks. You see already it's 4, it's 1, 2, 3, 4, 5. So it's almost 5 marks. Anyway, then they ask you to put in your net profit before tax. You see, they say they give you a mark for adding up. Just acknowledging that this contribution minus your costs, I get net profit, they give you a principal mark. So overall, you see, it wasn't that bad of a question. If you knew how to structure of how a direct costing income statement looks like, where the easy marks are, you would have scored proper. You wouldn't have spent the amount of time that you guys spent. Am I correct? Did you guys even get to net profit? Yes, Kathy? Kathy, your hands are...
Yes, I've just unmuted. On this section where it under less closing inventory, we've got variable manufacturing cost of sales. Then we've got variable selling and admin costs. Then under here as well, we've got selling and admin costs. So kindly explain how to differentiate the variable selling and admin costs there at the top, and the selling and admin costs given at the bottom.
This one, it's variable. This one is fixed. Under direct costing, all variable costs are taken into account to get your contribution. And your fixed costs are taken as an expense. So your sales and admin, they separated it for you to say The fixed one, it's 80,000. So this one, you expense. The variable, it's 2 rand per unit, meaning I use it in order for me to get my contribution. So it's taken into account up. The other one is down because it's fixed. Does it make sense?
Yes.
Yeah. Did I answer your question?
Yes, you did answer.
So that's the difference. Okay. Let's then look at how the absorption costing would look like. You guys, you are really, really comfortable with direct costing, yeah? So now let's go to absorption costing. And remember they said weighted average. So next time we'll look at first in, first out, how they do. Absorption costing method. Let's see. So sales, if you did your sales on top, I said your sales will be the same. So you see, they say sales from number 1. So you don't even have to calculate again and say 200 multiplied by 15. No, you just say sales reference from number 1. So there's your 3 million. Now, what's different here is that this cost of sales and this cost of sales is as follows. Opening inventory, you are given that open inventory. Here it is. It's 393. I told you it includes fixed cost. So you don't need to calculate your opening inventory. It's given. And you see that it's a principal mark for noting that it was already given and it's inclusive of the fixed cost. You don't have to calculate it. As opposed to under direct cost, you had to because you wanted an opening inventory with variable cost. Variable manufacturing overheads, you don't need to calculate it. You can take it from A, that 3.3 million. What you had to add, it's the fixed manufacturing cost, which is the 150. You add it here. It's given also, you don't have to calculate. You put it in to acknowledge that under absorption costing, part of my cost of sales is both variable and fixed. So you have your cost of goods available for sale, right? You have it here. So now you have to calculate your closing inventory. Closing inventory, same, just like that other side, you have to apportion it. So you take your 7.5, which you already calculated, over the 22,500, which you already calculated, multiply by this 3.8. Then that's your closing inventory. So that means that from the minute that we started from sales to cost of goods of sales, the only thing that you had to calculate was closing inventory. Do you guys see? And Lona, closing of it, I mean, calculating is just the apportionment. You didn't have to start all over again. You just have to apportion it. Okay? Then you get your gross profit. You get a mark for wording your gross profit. Get a mark. Then you do your selling and admin. But in this instance, back to the question that was asked, you put both variable and fixed as is your expenses. Then you get your net profit. Any question? Do you guys see that actually absorption costing portion, it wasn't that bad because everything was almost from A. Now you're just rearranging it, showing that you understand how it works. Any questions? You guys are quiet.
Yes, ma'am, I do have a question.
Let me hear.
Under opening inventory. So if it was not given, which amounts we were going to use?
Well, if it's not given, the information here was going to tell you what it is. If not, you'll have to calculate it, but the information will lead you. Sometimes you are given, sometimes you have to calculate. Not a thing where it's always there. So you will have to find out what is the fixed cost from last year, added by what you calculated as your variable cost. Then you get that full cost of saying fixed is this much, variable is this much. I add those two, I multiply by 2.5. But in this instance, they didn't tell you the cost per unit, their fixed cost. So it was given. So what I'm saying is that the question paper will lead you. Sometimes it's given, sometimes it's not given. You just have to know that under absorption costing, my cost, whether it's opening inventory or current production cost, it's variable plus fixed.
Okay, thank you so much. Now I understand.
Yeah. Others, any question? Is it clear?
Yes, ma'am.
So I'd say that, thanks for answering. I'd say that let's make sure that we understand. I'd say go revisit this topic again so that you know the principles of saying absorption costing includes variable and fixed manufacturing costs. Right? Understand under variable costing, it's only variable cost. And for me to get my contribution, I have to take into account all variable costs, meaning both manufacturing and non-manufacturing. And my fixed cost is an expense. Once you know what I'm just speaking about at the moment, be comfortable to know what's variable manufacturing, what's non-manufacturing. Embed them, like understand to a point where you can see the differences in the cost. Then you get to a point of saying, how does my income statement look like? You do your notes and you put an income statement without answers, how it looks, what are the difference between the two? Know them by heart. Then attempt the questions. Practice to a point where now you don't second guess yourself. Is this variable? Where should it be? How should I put it? How should I treat it? Should I include it? Should I not include it? You would remove all those noises and uncertainty, then you should be able to move forward to the next topic. But direct and absorption cost is a very key topic, so you need to understand it. Once you understand, you'll see it will take you a few minutes for you to attempt the question. Literally a few minutes. Okay. Any questions? We're about to close.